So if you're a new trader, or maybe you've even been doing it for a few years with mixed results, I find one of the things that can be most frustrating or most overwhelming about learning how to trade is just the sheer number of indicators that are out there. There's so many different indicators, and just knowing which ones to use and how to use them correctly can make a huge difference in your trading success. I find that most people who are first learning how to trade are using way too many indicators, and they're usually using them not the way that the indicator was intended. So how do you set your chart up? Well, that's exactly what I'm going to show you in this video. So stick around after the intro, and I'm going to show you what indicators I use, how I set up my chart, and what I look for before getting into or out of a trade. All right, so let's get right into it. So this is what my chart setup looks like. As you can see, it looks, I'll say, fairly clean. And what I mean by that is I don't use a lot of indicators. I have a few indicators that I like, and I find that if you just minimize what you're looking at, it really makes it a lot easier to make decisions. If you're going back and forth and switching between one indicator to another, and like I said, trying to find that perfect one that's going to give you the right results, all it does really, in my mind anyway, is create confusion. If you stick with certain proven indicators and just learn how to use them properly, I find you'll have way better results. So let's start off with the main part of the chart here. We'll go over the indicators that I have on here, and then we'll talk about the ones that I have down below. So up on my main chart, there's really very few things that I have on there. Let's start with the Bollinger Bands. So the Bollinger Bands are these two outer gray lines. Obviously they darken when you hover over them, but typically they're the gray lines. And what they do is they show, the way I have them set up anyway, is they show two standard deviations of price movement. So let me explain what that means. The reason that Bollinger Bands are so important, really they give you two pieces of critical information. One is they tell you if the volatility is increasing or decreasing in the stock. So for example, if we look at this area over here, you can see the Bollinger Bands were very wide. And they went from being wide to this narrow section down over here. Now, at the same time as the Bollinger Bands narrowed, you can see that what was happening with the price. Basically, it was just trading sideways. So what the Bollinger Bands are telling you is just a visual cue to show you that the volatility in the stock went from high volatility to a period of low volatility. Now that's really important to know depending on what type of trades you're making. For example, if you're making breakout trades, you want to know when the volatility is really low, because look what happens after a period of low volatility. The Bollinger Bands open up again to a period of high volatility. And that's just a cycle that repeats itself in any stock. So it's just a really nice visual to have that kind of shows you if the volatility is increasing or decreasing in a stock. Now, the other really nice thing about Bollinger Bands is, what's one thing you notice about the price action when you look at this chart? Well, one thing that really jumps out is the price is almost always encapsulated inside these Bollinger Bands. And the Bollinger Bands expand and contract as needed, but the price always stays within them. Well, why is that? Like, if we scroll back here, I mean, you can see that, again, the price is always in between. You get these couple days, 2 days it actually closed above the Bollinger Bands and came right back in. Same thing, it stays inside, riding right up against the top of the Bollinger Band. Some moves outside of it intraday, but closing within. And then again here, you have 1 day where it closed outside the Bollinger Bands and immediately came right back in. So the reason for that is actually quite simple. To understand what the Bollinger Bands are doing, let's actually open up the settings that I have. So here we see the Bollinger Bands. You just click on the settings button. And the way I have mine set up is it looks at the last 21 days. That's a common setting for short-term or swing trading. You want to look at about 21 days. And then the way I have my Bollinger Band set up is the bottom line shows -2 standard deviations, and the top line is +2 standard deviations. So in other words, the Bollinger Bands are tracking 2 times the standard deviation of the price movement. So if you're familiar with statistics, now you'll understand that the price 95% of the time will be within 2 standard deviations. So that explains why when you look at this chart, if we go back to here, we can see that at least 95% of the time, or maybe even higher, the price is inside these 2 standard deviation lines. Now, what you could do, and I sometimes will do this, I typically don't leave my chart set up that way. I leave it on 2 standard deviations because it's just what I find, works more reliably. But let's say a stock has a really huge breakout and the price is way outside the Bollinger Band. Sometimes what I'll do is I'll change these numbers to a 3 just to visualize where the 3rd standard deviation is. So you hit OK, hit apply, and OK. So now what that did, you can see the Bollinger Bands expanded a little. They're now a bit farther away from the price action. But look what happened to the price. I can't find a single day here anywhere where the price actually closed outside. Well, I guess here it did, just barely on this day here. Where it closed outside of the Bollinger Bands. Because again, from a mathematical perspective, if you're looking at 3 standard deviations, now the price has to be within those bands 99.7% of the time. So again, it'll be extremely rare to find a day where the price closes outside. Now, the reason I would look at something like this is, I don't know if I can find an example of it on this chart, probably not, but if you were, I don't see one here. If you were to have, a really big breakout, say maybe after earnings or something, and the stock really explodes. And if you were to change your Bollinger Bands to 3 standard deviations, and if the price is way outside of that, that's usually a good indicator that it's not going to move any farther in that direction, either up or down. And that would be an excellent place to take profits if you're in the stock. Definitely not to buy it, and possibly to even look at maybe shorting it or buying some puts on the stock. So again, it's just a really good indicator that tells you on how price should behave, or how price is behaving compared to how it should behave mathematically, within the standard deviations. All right, so let's just go back and I'll change this back to 2 standard deviations. And that is, like I said, where I normally keep it. So you hit apply, okay, and there you go. So now we're back to 2 standard deviations. All right, so other than the Bollinger Bands, the other thing that I have on this chart is moving averages. And I got a few of them here. So I'll run through and explain how I have those set up. So I like to use both shorter term and longer term moving averages just to see where the short term trend is in relation to the longer term trend. So for example, in this case, you can see that all of the moving averages are actually getting really tight together. And that's because the stock has been consolidating, over a period of time. When that happens, these moving averages get really tight. They're all coiled up together. And that usually tells you that the stock is going to have a big move in one direction or another. Now, it doesn't tell you which direction. So you can't prematurely get into a stock until you see a confirmation of that move. But what it does tell you, again, combined with the Bollinger Bands getting tight and the moving averages, really coiled up, it tells you that you should start to expect some type of breakout either to the upside or the downside. So I got 4 moving averages on my chart. I have the 8-day, the 21-day, the 50, and the 200. For the 2 short-term moving averages, that's the 8-day and the 21-day, I want them to be very responsive. In other words, I want them to show any sudden movements in the stock. So, if the stock does a really quick breakout, again, let's see if I can find an example here. Well, even this. So if we look at this area here, you can see that, as the stock broke out of this short-term consolidation here, the 8-day and the 21-day really move quickly from where they were. And obviously the 50 and the 200 are much slower moving. Now, that'll happen regardless, just because of the way the averages are calculated. But to kind of help this along, what I do is for my 8-day and my 21-day, I use what's called an exponential moving average. So again, we can look at the way I have this set up, and you can see that, let's see, those are the 50, the 200. Okay, there's the 8-day. So for the 8-day, what I use is the moving average exponential. And then for the 21-day, it's actually not a separate item in here. It's part of the Bollinger Bands. So I'll show you that one here in a second. But let's look at the 8-day first. And so when you set this up, it's based on the closing price at the end of the day. Obviously, the period is 8 because it's an 8-day moving average. And then really the only things you have to set up is, choose the color and what type of line you want. Everything else is already set up. It's a, prepackaged item that comes with ThinkOrSwim. So let's back out of there. So again, that's an exponential moving average for the 8-day. The way the 21-day is graphed, I mean, you could draw it as a separate line. But basically, when you're setting up your Bollinger Bands, so if we take a look at these again, so you can choose what period you want for your center line. So here I have 21 for my center line moving average. And that's also what's used to calculate the standard deviation. And down here, you select the average type you want to use. So again, I got exponential. You can use simple, weighted, Wilder's, Hull. Again, I prefer the exponential for my short-term moving averages. So let's just back out of here. So again, the purple line is my 8-day, the blue line is my 21-day, and those are both exponential moving averages. Now, for my longer-term trend lines, that being the 50-day and the 200-day, I want those to show me what the overall longer-term trend is in the stock. So in other words, if I'm trading a stock, before I look for a stock that's in a consolidation and possibly ready to break out, I want to make sure that stock is actually in an uptrend prior to getting into that consolidation. And so that's what I use the 50 and the 200-day for. And so for those ones, I don't want them to be largely affected by any little move or by any sudden move in the stock price. I want them to be more gradual and really give that longer term indication of trend. So for those, instead of using an exponential moving average, I just used a simple moving average. So again, if we open up this, you can see that the 50-day and the 200-day are both simple moving averages. And if we go into the settings, again, there's really not much to adjust. You put in a period of 50 and you select what color and line type you want, and that's really all you need to do. Everything already comes prepackaged. I guess in case you didn't know, maybe I should show this too. The way you add these to your chart is you just search for them down on this side. So say, for example, if you want to add a simple moving average, you just type in simple, there's your simple moving average, and then you would add it just by hitting the add selected button. So I guess I can do it just to show you. When you hit add selected, there it is right there. It shows up as a new item, and then you just go to the settings and you choose what you want. So for example, I already have the 4 averages. Let's say I wanted to add a 100-day moving average. Then for the length, you would just type in 100. You would choose what color line you want. You would hit OK, apply on the next screen, and then it would be on there. So I'm not going to do that in this case. I'm just going to cancel out of this. But that's how you would set one of those up. So I'll just cancel out of this screen also. So that's the moving averages. And again, maybe I'll just explain real quick. So the difference between an exponential and a simple moving average is that the exponential moving average gives more weighting to prices that are closer to the current date than prices that are further back. In other words, if we're talking about a 21-day moving average, today's date, yesterday, the day before will have a higher weighting when calculating the average than the day that was 21 days ago. That will have a lower weighting. Whereas a simple moving average gives an equal weighting and basically just adds up all the prices from 21 days, divides it by 21, and there's your moving average. So that's the difference between those two. All right, so there is only one other thing I have on this main screen, and you can choose to have this or not. I'll explain to you what it is and I guess how I use it. I don't use it to initiate my trades. And that's these dots that you can see. They change from red to green. And what those dots are is they are the average true range of the stock price multiplied by 1.5. So let me just show you on here how those work. So it's this one right here, the ATR trailing stop. And again, if you want to add this, all you do is search for ATR trailing stop up on the left side here and add it. So the way I have this set up is I use this just for swing trading, not for investing. I use this purely for swing trading to know where to put my stops. So because of that, I want a very short-term view. So I use an 8-period moving average. And then, like I said, this is a 1.5 times ATR. So my factor is 1.5. So what that does, and again, I'm using, because it's an 8-day, it's a short term, so I want to use the exponential moving average. Now, what that does is it calculates the average true range of the stock price over the last 8 days using an exponential moving average. Then it multiplies that by 1.5. What that tells you is the average true range is the expected daily move for that stock. If the stock were to move more than that amount, it usually indicates that something is changing in the price action. Either a trend is ending, maybe, and it could be just a short-term trend that's changing, but it indicates that something in the stock price action isn't quite right. So you don't want to use, a 1.0 ATR. You want to give it a little bit of room. So I use a 1.5 ATR. So the way I use this is, let's say I were to buy this stock today, which actually, now that I'm looking at this chart, is actually a pretty good buy point. You can see, well, let's just do a real quick analysis. You can see the stock's been consolidating for a long period of time. The Bollinger Bands got pretty tight. It did have this pullback, which now looks like it could have been a fake out, just to shake the weak hands out of the stock. It's moved back above the moving averages. The averages are really tight, consolidating. They're starting to point upwards. And today we got this really nice move up. Unfortunately, the volume's kind of low, so maybe it's not the best day to be buying. But got this nice move, but push off of the moving averages. So let's say you were to buy this stock today. Obviously, there are other things to look at, but one of the things I use when trying to determine where to put my stop is these 1.5 ATR dots. So if I were to buy the stock today, depending on my position size and depending on how aggressively I'm buying this stock, I would either put my stop, right below these moving averages and today's low, or if I want to give the stock a little more room to move and, say maybe get in with a little lower position size, but give the stock a little more room in case if it consolidates a little longer before continuing up, putting your stop right below the 1.5 ATR is actually a pretty safe place to put it. Now I won't go through, that's a whole, I guess, separate video that we could do on ATR. So I won't go, I guess, in a lot more detail, but I'll just show you this. Like when a stock does break out and gets, above and these dots turn from red to green, I don't necessarily use that as the buy point, because, so that was on this day here, you can see that the stock was consolidating, kind of slightly moving lower. It moved up above the 1.5 ATR line. That changed the dots from red to green. Now, I wouldn't say that's the buy signal because again, the stock just continues to consolidate. I would wait for this breakout. Okay, so you buy the stock on the breakout, and then I use these dots as a location of where to put my stop. And you can see once you do that, once you get a breakout, you can see it's actually quite reliable. If you were to put your stop right where the 1.5 ATR is, you really don't get stopped out. Even on these pullbacks, you never would have got stopped out of the stock. You would have stayed in it and really rode it up pretty much right to the top before it started to consolidate. And on this day here, I guess you would have been stopped out. So I mean, that would have been a pretty nice run. If you got in down here somewhere and say you got stopped out right around here, that's about a 16% gain. So that's how I use those, not as a buy signal, but just as a location on trying to help to determine where to put your stop after you're in a stock. All right, now let's look at what I got down here. But before we do that, let me just say this. If you were to set up your chart the way I have it up here, and let's say you had nothing down here, all you had was this screen, you could do really well in trading without looking at any other indicators. Now, if you really want to improve your performance from there, the one single best thing that you can add to your chart is volume. If you use everything that we just talked about now and, drawing proper trend lines, following price action, and if you follow price action combined with volume, that is all you need to make money in the stock market. It is probably the most effective way to analyze stocks and by far the least confusing. Like I mentioned at the beginning, if you're looking at too many indicators and trying to make sense of all of them, you're just going to confuse yourself. I know I do it. Some of my worst trades happened when I was using too many indicators or going back and forth between indicators. My best trades, my most profitable trades, I've made looking purely at price and volume. So I would definitely say volume is something you have to add to your chart. It's really simple to do. Again, you just open up the strategies tab. You would search for volume. Now I use a 20-day average for volume. So what that means, if we open up this setting, is on my volume plot, this line, this I don't know what you call this, brown tan line, what that's showing is the 20-day moving average of your volume. So it's really important to know if your volume is below average, at average, or an above average day. And that's what this line is showing here. So let's just close out of that. And again, really simple to add. All you would do is search for volume on this side, hit the add selected button, and it shows up down here. Now, one other thing you could add, you see these blue dots here. The blue dots show volatility. Now, I like to put it on this chart just because it's kind of out of the way. Some people, might put it on the top chart here. The only reason you would want to add this to your chart or I'd say definitely the main reason, is if you're trading options. You want to know what the implied volatility of the stock is if you're buying or selling options. That's the main thing I use this for. So again, it's probably more than what I can cover in this video, but I can show you how to add this if you are interested. Basically, same thing. It's a pre-populated indicator from ThinkOrSwim. It's called implied volatility. So you would just search for that here. You type in IMP, there it is, volatility, and you would just hit add selected. And what that does, like I said, there's nothing really to adjust. It's all, you know, pre-populated, pre-calculated, other than choosing the color and, you know, how you want it drawn. Nothing else to adjust there. But what that does is it gives you the implied volatility of the stock. And the main thing I use that for is when the implied volatility is really high, that's a great time to be selling options. And when the implied volatility is really low, that's a great time to be buying options. And that's, you know, the main thing I use this for. If you put it on here, great. If you don't want to use it, you know, you're really not missing out on a lot. So if you were to set your chart up like this, you really don't need anything else. I mean, you can do extremely well and be very profitable just by following the price action and looking at the volume. Again, you want to look for volume to confirm what you're seeing in the price. So like I mentioned today, this looks like a great candle, looks like a really good buy entry, but then you look at the volume and there's no volume there. So what this is telling you is that this move today might not hold up. This move today is probably just being driven by retail traders. It's not a lot of institutions that are buying today. So this could very easily sell off. And, you know, because the volume is so much lower than these red bars and way below average, this isn't something that you would trust as a breakout move. And so that's how you use volume in combination with price. Now, you can probably see I've got two other indicators on here. I'll run through them really quick. I don't rely on these a lot. And to be perfectly honest, there are times I even take these off my chart. There was a time where I'd go back and forth where I'd only put them on, you know, if I wanted to look at them and then remove them again. It's just, you know, it's kind of a pain to keep adding and removing them. So what I decided is basically I just leave them on. But typically I look at my chart like this. You know, I keep these small. This is what I focus on. But I really don't look at these a lot. I do have a separate video on how to use the RSI correctly, and I'll post a link to that here, because I'll be honest, RSI is something that most people use incorrectly. Just as far as, you know, looking at a stock that's overbought or oversold, the way that people interpret that is usually the exact opposite of how this indicator was meant. So like I said, I'll post a link to that if you want to watch that video. That'll teach you the correct way to use RSI. But like I said, to be perfectly honest, I very rarely look at this. I look at price and volume. The only reason I have RSI on here is it is nice to see the RSI trend. And then same thing for the MACD. Again, I very rarely rely on this. Both the RSI and the MACD are considered secondary indicators. So your price and volume are your primary indicators. Anything else that you really put on your chart is a secondary indicator. It's basically a lagging indicator that's telling you, momentum or price movement based on historical. It's not predicting what's going to happen next. So I'll sometimes look at this only because, I want to know, is the trend line above zero? Is it below zero? Is the short-term line above or below the long-term line? So I'll glance at these, but I really don't use these to make decisions on getting into a trade. If anything, sometimes I will use these to make decisions on when to take profits. If I'm already in a stock, say I'm in a stock and maybe the price has been rising over the last several days or last several weeks, but you can see either in the RSI or the MACD or both that the momentum has really died off. That could be a good indication that, okay, maybe now it's time to take some profits. But I very rarely use these. Actually, I don't think I ever really use these to make a decision to get into a trade. If I'm deciding to get into a trade, it's always based on price, the moving averages, trend lines, breakouts, and then combined with the volume. So, but again, just if you want to add these on, real simple to do. You just click the Edit Studies button, and you would search for them. It's basically just called RSI. This one's just called MACD. So you would just type in RSI, and there it is right there. You would go Add Selected. The way I have mine set up, if we look at the settings, I use a 14-day period. The most common settings for overbought and oversold are 70 and 30. So that's what these two yellow lines represent. And then you just select, what color you want your lines to be. That's really all that there is to adjust for that study. And then similarly for the MACD, we can look at those settings. Again, here you have to choose what you want your fast length and your slow length to be. I like to go with a 12 and a 26. A MACD length of 9. That's probably the most common, the most standard setting for MACD. For the average type, I use Exponential. Again, I'd want this to be very responsive. If you use a simple, the MACD is usually just way too far lagging to provide any kind of real value. So I like to use the Exponential for it. And then again, you just select, your color for your lines. You can select the color, for your average line, your zero line. If you want up signals, down signals, you just select what colors you want for all those. And really, that's it. I'm trying to think, what else I can show on here. I mean, I really don't use anything else for indicators. Occasionally, I might, throw on the Fibonacci extensions if I'm doing a bit more deeper analysis on a stock. Maybe something that I own, and again, I'm looking, has it retraced far enough that I should be looking at taking some profits or something. But there's really no other indicator that I use to decide to get into a trade. There might be indicators that I throw on here from time to time just to look at, how extended a stock is, or is it time to take profits? Is it time to exit the trade? But as far as getting into a trade, and I'd say probably 90% of the time, also making the decision on when to get out of the trade, all I use is these moving averages, the Bollinger Bands, and the volume. So it really is that simple. Honestly, if you keep your chart simple, you will do way better. It'll be way less confusing. You won't be trying to make decisions based on 5 or 10 different indicators. That's a common mistake that beginner traders make, is they use way too many indicators, and it clutters the chart. It just confuses things and causes them to make bad decisions on getting into trades. So hopefully that helps. If you got any questions on this, or if there's anything else you want me to cover as far as setting up the chart, you can post those down in the comment section. And hopefully this really helps your trading. So if you're enjoying these videos, or if you like the content of these videos, please hit those like and subscribe buttons. It does really help us out a lot. Greatly helps with the YouTube algorithm to get these videos out there and seen. So if you could do that, I'd appreciate it. And we'll see you next time.